Every financial expert tells you the same thing. Avoid debt, pay it off, live within your means. Now, zoom out. As of February 2025, the United States federal debt stands at over $34 trillion USD, according to the U.S. Treasury. That's more than the entire annual output of the U.S. economy, which was roughly $27 trillion USD in 2024, as per the latest Bureau of Economic Analysis data. If debt is dangerous, why does the most powerful government in the world keep increasing it? Why not just pay it down? Here's the uncomfortable truth. Modern governments don't just tolerate debt, they rely on it. And in many ways, the global financial system is built on it. Let's start simple. A government has two basic ways to fund itself: taxes or borrowing. When spending exceeds tax revenue, the difference is called a deficit. To cover that deficit, the government issues bonds. A bond is a promise. You lend money today, the government pays you interest, then returns your money later. That sounds risky. But here's what most people miss. When the U.S. Treasury issues bonds, it isn't just borrowing money. It is creating the foundation of the global financial system. U.S. Treasury securities are considered the benchmark risk-free asset worldwide. Banks hold them. Pension funds rely on them. Insurance companies use them to match long-term liabilities. Foreign central banks accumulate them as reserves. As of the latest available data, 2024, the total U.S. Treasury market exceeds $26 trillion in outstanding securities. That market is deeper and more liquid than any other bond market in the world. Now, let's simplify everything with a small, fictional example. Imagine a country called Northland. Northland produces $1 trillion in goods and services each year. It collects $250 billion in taxes. But it spends $300 billion. There is a gap of $50 billion. So Northland issues $50 billion in government bonds at 4% interest. Investors buy them. Now the government has cash. It builds infrastructure, pays teachers, funds research, supports healthcare. That $50 billion enters the economy. Construction companies get contracts. Workers earn wages. Businesses expand. The economy grows to $1.05 trillion the following year. If growth remains around 5% and the interest cost is 4%, the debt burden does not spiral out of control. Here's the key relationship. If economic growth exceeds the interest rate, debt can stabilize or even shrink relative to GDP. That's why governments focus on sustainability, not elimination. Now, let's increase the tension. What if growth slows to 2%, but interest rates rise to 6%? Now the math flips. Interest payments grow faster than the economy. Debt compounds. Northland must either raise taxes, cut spending, or borrow more. This is where debt becomes fragile. So why risk it at all? Because government debt serves three critical functions. First, it creates safe assets. Second, it enables monetary policy. Third, it spreads the cost of long-term investments over time. Let's unpack that. In the United States, federal revenue in fiscal year 2024 was approximately $4.9 trillion USD, according to the U.S. Treasury. The largest revenue source was individual income taxes. Spending, however, exceeded $6.7 trillion USD. The largest categories were Social Security, Medicare, and national defense. These are politically sensitive programs. Cutting them quickly is difficult, so deficits persist. Debt fills the gap. But that debt becomes an asset for someone else. When a pension fund buys Treasury bonds, that is government debt on one side and retirement security on the other. When banks use treasuries as collateral in short-term funding markets, they support trillions of dollars in financial transactions daily. Without a large supply of safe government bonds, modern financial markets would struggle to function smoothly. Now, let's examine real-world case studies. The United States. Debt-to-GDP ratio roughly 120% as of 2024. Yet, U.S. Treasury yields remain globally competitive. Why? Because the U.S. dollar remains the dominant reserve currency. According to the International Monetary Fund, about 58% of global foreign exchange reserves are held in U.S. dollars as of latest available 2024 data. Global demand supports U.S. borrowing. Now compare Japan. Japan's debt-to-GDP ratio exceeds 250% as per latest available 2024 data, much higher than the United States. Yet Japan has avoided a sovereign debt crisis for decades. Why? Because most Japanese government bonds are held domestically, and the Bank of Japan has maintained extremely low interest rates for years, including yield curve control policies. Now contrast that with Greece during the European debt crisis. In 2012, Greece's debt-to-GDP ratio exceeded 170%. Because Greece does not control its own currency independently within the euro system, it could not print money to ease the burden. Bond yields surged above 30% at peak stress levels. Borrowing became unsustainable. Confidence collapsed. Debt itself wasn't the only issue. Trust was. Now let's introduce key financial metrics that governments and investors watch carefully. Debt-to-GDP ratio. This measures debt relative to economic output. High levels can signal vulnerability. Interest expense as a percentage of revenue. In fiscal year 2024, U.S. net interest outlays exceeded $900 billion and are projected to cross $1 trillion annually if current rate levels persist. That makes interest one of the fastest-growing components of the federal budget. Primary deficit. This is the budget deficit excluding interest payments. If a country runs a primary surplus, it can stabilize debt. If it runs persistent primary deficits, debt accelerates. Another key measure is average maturity of debt. Longer maturities lock in borrowing costs for longer periods. Short maturities expose governments to refinancing risk when rates rise. Now consider what happened between 2020 and 2022. During the pandemic, the Federal Reserve purchased trillions of dollars in Treasury securities through quantitative easing. This lowered yields dramatically. The 10-year Treasury yield fell below 1% in 2020. That made borrowing historically cheap. But in 2022 and 2023, as inflation surged, the Federal Reserve raised its policy rate aggressively. The 10-year Treasury yield climbed above 4%, at times approaching 5% in 2023. That shift dramatically increased future interest costs. Higher rates mean new debt becomes more expensive, and old debt must eventually be refinanced at those higher rates. Now we reach the structural risk. The U.S. population is aging. Entitlement spending is rising. Healthcare costs are growing. Geopolitical tensions increase defense spending. At the same time, political polarization makes fiscal reform difficult. Debt is sustainable as long as growth, inflation control, and investor confidence remain aligned. But if any of those weaken, borrowing costs can rise quickly. Here's the subtle paradox. In personal finance, being debt-free feels safe. In macroeconomics, eliminating all government debt would remove trillions of dollars in safe assets from the global financial system. Banks would have fewer high-quality collateral options. Central banks would lose a primary instrument for monetary policy. Global liquidity would shrink. Debt is not simply a burden, it is also a tool. It finances infrastructure that produces long-term growth. It stabilizes recessions. It supports financial markets. But it also accumulates silently. And once interest costs consume too much of government revenue, flexibility disappears. So governments don't aim for zero debt. They aim for sustainable debt. The real constraint isn't a specific dollar figure. It's confidence. As long as investors believe a government can manage inflation, grow its economy, and honor its obligations, debt can expand. If that belief weakens, bond markets adjust instantly. Yields rise. Currencies move. Policy shifts. Debt is power. Debt is leverage. Debt is stability. Debt is risk. The system works until it doesn't. So the real question isn't whether governments should have debt. It's this: where exactly is the line between productive borrowing and structural fragility? Because history shows that markets don't warn politely. They reprice suddenly. If this breakdown helped you see government debt differently, subscribe. In the next video, we'll explore how bond markets quietly discipline governments and why that invisible force may shape the next decade of economic policy.